Welcome back to another video. In this one, we're going to be talking about 8 tax saving strategies for property investors. So let's get right into it. Strategy number 1 is using the primary place of residence exemption. What does this mean? If you lived in a house and you have no other property, then that property can be your primary place of residence. And where you only have one primary place of residence and no other properties, you can use that property and completely be exempted from tax. The second strategy we can use is the 6-year absence rule. This allows you to treat your main residence for another 6 years as your main residence if you are stationed overseas or for whatever reason you needed to leave your house. The 6-year exemption can be reset prior to that 6-year period lapsing. This means that you can come and move into your house again, extending it by another 6 years prior to that period ending. During that period, you can rent out your property and you'll be taxable on the income less the expenses from it. But there will be no capital gains tax for that period, which is just another plus. The third strategy is to use depreciation. You won't believe the number of tax returns that I've seen that don't have a depreciation schedule. We've asked our clients that we're going to pause the preparation of these documents until they get a depreciation report, and we've put them in contact with various depreciation report providers. We can link a video to this going into the depth of how depreciation works and providing the contact details of those depreciation report providers. Depreciation will allow you to increase your expenses, thereby reducing the profit on the investment property and the amount you're going to be taxed on because of a smaller amount of profit. So you can see how beneficial that is. The fourth strategy that you can consider is negatively gearing your investment property. What does this mean? Well, there are 2 aspects to this. The first is a cash flow physical aspect, and the second is an income tax aspect. The cash flow aspect is where expenses are greater than the income. So from a physical cash flow perspective, you are in the negative, and therefore your income from that property doesn't cover all the expenses, and you have to use money from your own pocket to cover the shortfall. The other aspect is where the income is greater than the expenses physically, but because you use a depreciation schedule that's allowable by tax law, you further increase the expenses by a non-cash amount and therefore end up in a loss position for income tax purposes. Again, you can imagine that will reduce the tax that you need to pay, meaning you'll have more money in your pocket for family, for adventure, just to take a holiday or to do anything else that you like to do with that money. We're moving on now to the 5th strategy, and that is using the 50% 12-month capital gains tax discount. It's very important to understand that this is based on the date on which you signed the contract and not on settlement date. So it's very, very important to be mindful of that date and to trigger a capital gains tax event after 12 months from the date that you signed the contract. Another aspect, something to keep in mind, is that once you apply the 50% capital gains tax discount, you are taxed at your marginal tax rate, whatever that tax rate is. The 6th strategy to consider is to increase the cost base of the property prior to sale. What does this mean? A lot of people do renovations on their homes, but they don't look at that expenditure, or they don't hold the receipts for that expenditure. And that means they forget how much they spent, which doesn't add to the initial purchase price of the property. So when they come to sell, the purchase price or the cost base isn't as high as it should be, considering all the work that they've done on the property. And therefore, they end up with a higher sales figure than what is necessary. So it's very important to record and keep receipts, invoices, contracts, so on and so forth, to prove that you have improved that property and that the cost associated with it is that much extra. Another aspect for increasing the cost base is recording the holding costs. Some people have investment properties which they don't use to generate income, and therefore they can't deduct any expenses. When this happens, what you can do is you can record expenses such as interest, council rate, land tax, so on and so forth, and add it to the cost base. So when you come to sell, all these expenses will come into play and reduce the profit you make on that particular property. Number 7 is to utilize capital losses. What does that mean? If you have carried forward capital losses or losses that you've incurred from another asset, such as the sale of shares, you can offset that loss against the gain, either reducing the gain or completely wiping it out. And if you wipe out that gain for the given year, then there is no capital gains tax that will be paid on it. It won't be taxed at your marginal tax rates, and you're going to completely avoid it. So that's just another way you can save a lot of money by, again, utilizing the carry forward capital losses or capital losses incurred in that particular year. Lastly, at number 8 is timing the sale of the property. Sometimes in a given year, your income will be less than in another year. This is the ideal time to sell a property, having consideration for other things that you need to bear in mind. What this means is that the sale of the property will be taxed at your marginal tax rates, and because your income is not as high, you'll be taxed on a lower figure than had you sold in a year where you have higher income from, say, salaries and wages or other investments. That's just another way of ensuring you pay lower tax and strategize to make the most of your investment property sale. Thanks for watching another video. Now is the perfect time to subscribe to the channel, hit the notifications bell icon to ensure you receive notifications of the videos that are being posted on a regular basis and as soon as they are uploaded. This will help keep you informed. We also appreciate if you write some comments regarding what you found valuable, anything that you'd like us to include in the next videos, or anything you believe we could be doing better. We always like to improve our videos to provide more value to you. Thank you again. We wish you all the best until we see you on the next video.